is Yasin Nizami. I'm the real estate salesperson. Work in GTA and also some suburbs of the GTA as well. Um, and I was, thinking maybe I should invite one of my friend Nabeel Khan, who is in the banking industry, so we can share some of the secrets and tips and tricks that how the new immigrants and first-time homebuyers can qualify for mortgage. I know that a lot of people have a lot of questions that where this market is going and how the rates are climbing up. So I thought maybe it's a good idea to listen from Nabeel, one of the top experts in the industry. And Nabeel, over to you. Why don't you start the introduction?
Yeah, thanks for the opportunity, Yasin. So my name is Nabeel Khan and I work for Royal Bank. I'm the regional manager for mortgage market. We cover the GTA West region, and a fairly incredible team I have. And they work extremely close with the first-time home buyers, newcomers, and a lot of realtors, right? So we are very well diverse in terms of when it comes to the mortgage business. And particularly when we get together to talk about first-time home buyers and newcomers, this particular segment is very near and dear to our hearts because a lot of our clients are first-time home buyers. We all were first-time home buyers at some point in our lives, and purpose of this seminar is just to share anything we have learned throughout our careers and any tips we can share with everybody to learn about the mortgage part of the business. There's a lot of questions, especially from the mortgage side of business, whether if you work with the realtors or mortgage specialists, there's tons of information available. So our ask or our goal is just to, whatever time we spend together, if you are sharing this, as you said, you're recording it, for the folks who have any questions, they can always post or ask us, and down the road, I'm more than happy to take those questions throughout as well.
Awesome. Thanks very much, Nabeel. So let's get started now. We have we have 5 minutes past. I think a lot of people are still confused in terms of whether they should buy this time or not. Interest rate were low and now they're climbing up. So what do you see as a trend, like where it is going? Do you see that interest rate will climb up back into like 3 or 4%, or you think it's going to stay as it is and then slowly they will move up?
Yeah, so I'll give you this question. I'll answer in 3 parts, right? So the first part will be about fixed, the second will be about variable, and third will be about stress test, which is announced today. I don't know if later on, I literally just got the news around 4:30. So the rates are going to go up or not? That's a $1 million question, right? Now, the government of Canada is predicting that rates will be staying low till 2023. That's what the Bank of Canada is predicting. So what that does, all the banks, when we borrow money from the Bank of Canada, the rate which we use is called prime rate, right? Which drives our variable rate. So what that means, when the government is saying that, the Bank of Canada is saying that the rates will be low till 2023, our variable rate will be low till 2023. That's what the rates will be from the variable standpoint. Now talking about fixed rate is a different game. It is driven by many different factors, but I'll give you a couple of factors. One is the bond rate. When the bond market goes up, the fixed rate goes up. And when the timber and the lumber and the industry is getting expensive, the market goes up and then our fixed rate goes up, right? So the challenge, what it does is that it drives the fixed rate higher. So if you see in last 3 or 4 weeks, our fixed rates have gone up, but our variable rate has not gone up, right? So again, the 2 part, as I said, when clients ask us all the time, our rates are going up or not going up, and we always tell them that variable is staying the same, fixed is going up, right? And fixed has gone up to 70, 80 basis points in the last 3 weeks. So that's the rate part of the question, right? Now talking about the clients buy now, the clients don't buy now, right? So the stress test, which is going up from June the 1st, it is recently announced. In today's market, you can qualify for 4.79%. From June the 1st, you will be qualified on 5.25% or 2 basis point higher of your contract rate. So now let's say if you secured 2% or 2.24 mortgage, then 2% on top of that will be 4.24. The higher is 5.25, which means the OFC is saying you have to be qualified in 5.25. So what that does is when you go up on 5.25, your TDS becomes higher. And again, I'll explain in a few seconds later on what a TDS is. The ratios start to go higher, which means the qualifications start to become a challenge, right? So if you are able to qualify today, then from a mortgage standpoint, I'll encourage individuals to get yourself approved for a mortgage, buy a property, because after June 1st, the stress test come into the fact, and that's when you have to, the qualification will become a little bit harder, right? So I know it's a long answer, but I want to make sure that I try to cover as much as I can because
Yeah.
That drives the activity, right?
Yeah. And I think for people who do not understand that stress test, because this was introduced, I think, back in 2017,
Right.
and it was taken away, I think, in 2019 or 20 timeframe.
Yeah.
That also contributed towards this whole, crazy marketness because everybody was rushing into it and trying to take advantage of it, right? And I think one of the questions that people typically ask is, the house prices is going up. Like average house price right now in GTA is over $1 million. But not a lot of people can afford to take $1 million mortgage. How these people are qualifying for these mortgages?
Yeah, great question. So, what pandemic has actually shifted the activity outside GTA, right? So, I've been in mortgage business for almost 10 years now, and there used to be a lot of activity happening in GTA. Everybody wants to live in GTA because the jobs were based in downtown Toronto for that matter, right? Now, what the pandemic has done is people are working from home, and that means you don't have to go to work. You don't have to live in Toronto. You don't have to live in Mississauga or Peel. You can live wherever you want. So what it has done that, yes, GTA prices have gone up, but the activity is actually happening in Niagara Falls area. The activity is happening in St. Catharines. The activity is happening in Barrie. The activity is happening in Hamilton, right? So the data what we receive from RBC is massive amount of activity which is actually happening. The real estate transactions is happening in Niagara Falls side. That's where majority of the individuals are actually buying properties, right? So that's one part of the business where you see a lot of individuals. Price point is relatively still okay, as you know, in Niagara Falls and Barrie and all those areas are not that super expensive. So that's where a lot of qualifications from a first-time home buyers and newcomers are generally going there. Traditionally, you would not see our first-time home buyers going to Niagara Falls because their job is in downtown Toronto, right? Now they can go wherever they want because that is driving the activity, right? Now coming back to GTA, you know and I know the reason why prices are so high because the supply is pretty less at the time, right? So we are hoping, and I'm sure you guys are also hoping that when the markets start to open up, you will see some sort of inventory, which will mean the supply will come in, and that will reduce down the pressure on the demand, and then you'll start to see more of a balanced market. Today we don't have a balanced market; it's just a seller's
The
market, right?
seller's market.
Yeah.
That's true. That's true. Um, but I think even then, like the people who are buying these properties in GTA area, as we know that an average Canadian does not have salary more than $100,000. To qualify for $1 million house, you have to have at least $200,000 mortgage, $200,000 earnings, right? Um,
Yeah.
what are those factors that people are considering to get qualify for like $1 million plus mortgage? Like I know that there are some programs available like first time home buyer support program where
Yeah.
you can get some CMHC insurance to cover
Yeah.
rest of your down payment if you're not providing 20% down payment. Plus there are some RSP amount that you can withdraw. But if an immigrant comes and he does not have history here and they're just starting job, what is where do they start? Like how do they can start the process and get the mortgage approval?
Yeah. It's a very long question, so I'll give you a very long answer, right? Because there's a lot of things happening here.
Yeah.
So you're talking about a first-time home buyers and a newcomers, right? So there's many programs available for the first-time home buyers and newcomers. First, let's talk about first-time home buyers first, right? Now, how do you start? Now, let's say um, when you're first-time home buyer, you start to thinking to buy the house, right? That's your first step in your mind. There are many programs available. There are RSPs, you can start to put the money into it. And then once you start to put the money into it and you can start your savings program, you can take your money out tax-free. It's called RSP Home Buyers Plan, and that's available on the Government of Canada website. So what that does is when you take the money out, you're not getting taxed from the government, right? For the particular amount of money. So majority of our first-time home buyers are actually the ones that start to save money. How do you save money? Another question. You can start a monthly deduction plan, or you can start a automatic plan where money comes out from your bank account, right? And that money start to go into your bank account automatically basis. So you start to save a down payment from that way. That's a lot of people do this. A lot of other people use TFSA. Now, TFSA and RSP home buyers plan are two different things. But because TFSA is money which is coming after tax, you're putting it in a TFS account. RSP is where you put the money into your RSPs. It's not a taxable income. And when the time comes for down payment, you can actually take the money out through your RSP, which will not be taxed. And there's a repayment period from the government, right? So that takes a lot of individuals who are doing that at this point of time. Now, second thing where a lot of first-time home buyers are also operating in the space of, I'll give you an example. So, and this is the stat we received from the bank is pre-pandemic, Canadians used to live on a $40 billion saving, let's say, right? Now, I don't know exactly it was a number, but just to give you a rough idea that it was around 40 billion where we used to have in our savings as Canadians. Now, if you go back a year and a half, we haven't spent a lot of money. We haven't expensed a lot of money. We haven't traveled. So today, Canadians, we actually have $200 billion saved in our bank accounts, where it used to be 40 billion, right? So the savings have gone up by 500% or more. So what that has done, people have down payment, where we used to have challenges coming up with down payments, right? So let's take an example where if you have a buyer who's working in the market where he's looking to buy a $600,000 property, $700,000 property, right? Now, when you're referring to $1 million property, that's not the first time home buyers. Generally, typically, first time home buyers don't buy $1 million property, right? They tend to play around the zone of 5, 6, 4. That's the typical range they play. So if you're looking of first time home buyers, $400,000 to $600,000, that is 6,000. So the 5% they can put a minimum down payment. So 600,000 is the mortgage. If let's say if you want to qualify for a house, you have to put a minimum of 5% down payment, which is $30,000, right? 30,000 plus the closing costs and so on. So typically, if you're looking for a $600,000 property, you need to come up with $35,000 of down payment. Now, as I said, pre-pandemic, 30,000 will probably take 2 years or 3 years to save. In pandemic, people have saved it faster because there's no vacation happening in December. There's no March break happening. You're not going out to restaurants. You're not spending money on your expensive houses. I mean, your dressings, and I mean, there's a lot of money getting saved. So we have seen our first-time home buyers are quickly jumping into market because of that reason. So that is about more of a first-time home buyer question. Now, second thing we talk about newcomers, we have very good programs where individuals can come first-time home buyers. They're new to the country. They are professionals. We look at their credit. We look at the income, what they were earning. We look at their profession, which profession they are in at this time. And we also look at that, what other things they're doing to upgrade yourself. So giving an example, if we have some accountant, some doctor came to the country, they have enrolled themselves into upgrading their programs. We look at that as well, and then we are lenient to have them the mortgages approved in that scenario. So that's more of a bit of a light about the newcomer. How do the process start? Extremely strongly and very professionally recommended from me is always start with the pre-approval and deal with a mortgage specialist. So whenever you have a client or your clients are there, always start with a pre-approval. Two things really happen in that particular case. If you're first-time home buyers, when I was a first-time home buyer, I used to think, and this is a few years ago, I used to think that I'll be able to qualify for a very small amount of mortgage, right? Because little did I know about my finances back in the days. But when I went to RBC mortgage specialist, I was able to qualify for a higher amount. So then I can look for a different property than I was looking for before. That is a key element for anybody to start the process. And we have always said that. Now, many clients, when they start looking at the houses, they don't have, let's say, properties pre-approval. The challenge that happens is for me now, let's say if I go in the market and of course, if I look at $1 million property, I'll love the $1 million property as compared to a $500,000 property, right? Because more expensive, bigger rooms, bigger houses. Now, once I look at it, and when I come to get my mortgage pre-approval, if I don't qualify, then it starts to leave a bad taste in my mouth that, okay, I needed that, but I can't buy that, right? So it's extremely good point to sit down, get your mortgage pre-approval. It will give you some sort of idea, okay, how much you can be qualified for, what can you really afford, and then you should start targeting approach, work with realtors like you, where start targeting the approach, okay, what market I need to work on, what do I need to operate in, because let's say my bank has given me a pre-approval for 400,000, 500,000. I have this much down payment, and then I can start go look around. So I always tell people, not that I work for a bank, but every time the first step should be a mortgage pre-approval, should not be anything else. See where you stand, see what your finances are. A mortgage specialist will be able to give you a good guidance as well that, okay, you have, let's say 18,000 down payment, you'll be able to qualify for this one. If you can save a little bit more down payment, then you will be able to qualify for a better property and they'll be able to give you good advice. So that's where you start the very first process, right?
Okay, thanks. Thank you very much. I know this was very, long question, and then
I wanted to make sure that the
yeah.
information I can give is much good, right?
So with regards to pre-approval, a lot of people they get confused. Pre-approval means is it a guarantee or is it not a guarantee? What does it really mean in terms of legality? Like if you have a pre-approval, can I just go and then go on firm deal without any condition? Like is there any risk that I will not be able to get lending after getting pre-approval?
Yeah. Yes. So pre-approval is not firm at all. So pre-approval is just an assessment that, Yasin, if you're going to buy the house, this is what you should look for around this range. You should be able to find a property around this range. And then once you have pre-approval, then you bring the property back to us. So pre-approval is just to give you a number that play around this number. You should be comfortable. Now, once you get the pre-approval is never not firm. So again, and the reason why I'm going to take a pause here because sometimes when our clients who are new in the market, they try to get a pre-approval from someone. Once they get the pre-approval, then either they go firm, either they go builder property they buy, and they say that, you know what, I have a pre-approval. Pre-approval is not firm. So never. It's just an idea that you should be playing with this. Once you get the pre-approval, then you can come back and then you can give it to the bank and then you go get the firm approval done. Once the firm approval is there, and this is one thing that we also do at RBC, that once we give you the firm approval, you're good to go. Because at RBC, we always ask conditions up front. We always ask all the documents up front. So let's say once you give the approval, once we give you the approval, we give you a firm approval, you're good to go. Your mortgage will be funded in 2 months or 3 months or whatever the time period your closing is. We're not going to ask you more documents unless something happens in the business. But we don't. A firm means it's a firm deal. You can go at it. It's appropriate, right? So that's where the firm and the pre comes along. Now, second question was, can the clients go without financing condition? Now, this question comes to me all the time, right? That in this market, I cannot buy a property because a lot of clients are putting no condition for financing. Our stand is firmly put the condition on, put the kind of financing condition on. Now, I know you deal with clients and it's hard in the market. Whenever I talk to realtors, they say, Nabeel, what are you talking about? It's just, we can because there are 10 other offers without any conditions. But we always tell people is that if you are going without conditions, that's the personal choice you're making. We recommend to get condition Now, there's always two conditions which are always part of the business is, people talk about home inspection and financing. Home inspection, I don't comment, but financing, strongly recommend to get the financing condition done. Without the financing condition, it becomes a challenge to get the situation happen. I've seen some horror stories in my career where people have gone firm, and when they come back, the mortgages are not getting approved, and then it also opens a door of different. You got to work with the lawyers and sellers and buyers, and also there's too much happening. So, first-time home buyers, I mean, and everybody, I strongly recommend don't go without condition. That's our stand. That's my stand. Now, market might think otherwise. You might think otherwise, Yasin. I know you deal with realtors and the clients. It's a different thing, but we always stick with the conditional.
Yeah, I mean, in fairness, of course, I would definitely would protect my client and always put condition. But the reality in the market is, if you put
Yes.
conditional offer, you have a very slick chance that you will be able to compete in the first round, right? Because you will have 10 other offers, without condition, and you will not be able to look at by the seller. So tell me, what are those conditions when you have a pre-approval, you go firm, you sign the deal, and then you come back to the bank, and the bank said, no, I cannot give you lending. What are those reasons, or potential reasons you can guide us?
Yeah, absolutely. So you told us that, I'll give you an example, right? At the time of pre-approval, you told us that I make $100,000. And we told you that, okay, based on this and credit scenario where you are, you should be able to qualify for $500,000, right? 500,000. Now you go out there, you buy a property of 700,000. So that's out of the range to begin with, right? Second thing, once we run the numbers, when you submit the document to us again, you don't make 100,000, you make 80,000, right? That could be a second option. Third, by the time the pre-approval was done, by the time the firm approval happened, a matter of about 3-4 months, you ended up buying another amazing car, which increased your liabilities, right? Or something happened where credit got messed up, right? So situations start to change, right? So you bought a bigger property, the income wasn't there. Situations start to change, and that's where the challenge start to come in, right? Because the story was different, and now the story is something else. So that's where the pre-approvals start to drop. Doesn't happen very often, because when we tell the clients that, this is the range you should look for, majority of our clients stay around the range of what they look for, because people get a good idea, and nobody wants to honestly go when the bank is selling it to buy $500,000 and buy $800,000 property, right? I mean, individuals as clients know this their finances too, so we always recommend. So these are the major big ticket items, which I would say that's why you see the pre-approvals don't turn into firm approval. In seldom cases, very seldom cases, it also depends on the property as well. Right now, you ended up buying a property where it's not in a good shape, for example, right? So the bank will think that, okay, this property is a, let's say, for example, a rundown property, but you paid way overpriced. So then chances are we might decline the property. Very rarely happens, but it doesn't happen, right? So, but I think where our first-time home buyers normally look for, they are very cautious. They are very, I got to say this, that they're very smart, because every decision they take, because they don't know how much they don't know, right? So every decision they make, every step they take very smaller steps just to learn, just to understand.
Yeah.
And they don't go over the price of this. Now, coming back to your point about the $1 million range, very seldom we see people playing in that space from first-time buyers. The only time I see that is somebody has inherited a lot of money, inherited $300,000 down payment. They can play that space. They're a newcomer, they brought $500,000 with them, right? They can put that massive down payment, and they can go for that. Now, majority of first-time home buyers put 5%, 10%. And another point for first-time home buyers is whenever you're less than 20%, you have to get the mortgage insurance done. And I'll explain to the audience what the mortgage insurance is. If you are putting 5% to 20%, so 5 is the minimum, 20, and if you're putting less than 20%, up over 5%, you have to get the mortgage insured, which means third party, which is CMHC, Genworth, or Canada Guarantee, which I believe their name has changed now, they will protect your mortgage insurance, right? Which means it's called default insurance as well. So there's a premium attached to that. The premium is based on the amount of mortgage, the loan value itself, and all that can be seen on the CMHC website or whatever. So at the time you're looking for the property and getting a pre-approval done, always make sure how much down payment you're putting. Sometimes I'll give you an example. Sometimes first-time home buyers they do is they don't want to put 10% down payment, and so they don't want to buy the property this year because they know next year they'll be able to save 10% more, so they can avoid the 20% insurance. They can go over. So it also happens where people go over 10% and borrow some funds or whatever they get to down 20% down payment, and they don't get into the CMSC or the default insurance. It also happens, but for the listeners, first timer home buyers, majority of the time we see them getting into the CMS insurance as well.
Yeah, I think for the audience, I think this means that if you, for God forbid, you become default, then this third party CMSC will basically protect that loan for the bank, not for you, but for the bank. So the bank's money will be protected. So, okay, thanks for clarifying that. When you are going for qualification, you have variable rate option and you have fixed rate option as well. In these circumstances, when the market is so crazy and there is no sign that it's going to get slowed down because the conditions are not helping it, what do you suggest? Like, should a first-time home buyer or an investor as well, should they go for fixed mortgage rate or variable? What do you suggest?
It all depends on the client situation, right? So there's no one size fits all, right? It all depends on the particular client situation. Now, if you are that individual who really want to be on a particular cash flow, right? You only want to give a particular amount of money every month and you want to pay off your mortgage at a particular time period, then you should go for fixed. You should lock yourself into fixed. But if you are someone who is comfortable with the rate up and down, looking at the news every day, where the interest rate are, where the certain situations are, then people play variable, right? So that this is totally depends on the client situation. Now, I'll tell you, many clients, they just want to lock into fixed rate because they just like that, let's say $2,000 payment every month, and that's all they want to worry about, right? Now, some clients don't like that. They don't want a higher payment. The fix is about two north of two, and variable is lower. So some clients like to have variable because they're willing to take that chance, right? They're okay to pay a lower rate, and they want to keep, let's say, their monthly payments lower, for example, right? So they want to have a variable. Now, it also depends that if you are staying in the property for a long time. Now, if I want to live in this house only for 2 years and move out or sell out, then I should not be looking for a fixed 5 year, let's say, because at the end of 2 years, I have to pay the penalty, right? I'll be under the contract. And fixed tends to be a heavier penalty as compared to variable. So if you know that you're going to move in a couple of years from now, or you're going to sell your property from now, then people go for variable. So this is totally based on client situation. There's never one size fits all. Fixed. Some clients are very heavy in fixed. They are comfortable with what they pay, and some clients are willing to take the chance because variable is low, so they want to pay low, right? So
yeah,
based on the situation.
Yeah, and I think it depends upon whether you are buying it for your own principal residence or an investment property. Like if you're buying it for yourself, that means you will at least live in this property for 5+ years. Makes sense to have fixed term mortgage and then have a predictable cost. Versus if you're just buying as an investment property and you want to put it on rent, and maybe 2 years or 3 years after you want to move on, then of course it makes sense to have a variable interest rate.
Yeah, and generally investors, I've noticed they go this route. Yeah.
Yeah. And
Yeah.
in terms of the amortization period, uh, what do you suggest? Like, should people go for 30 years plus, or should they go for the lower term? I know that if you reduce the term, your monthly payment will increase.
Yeah.
And if you go for longer term, of course, you will end up paying more money in interest, but your monthly payment will be reduced, right? So, what's your guidance in terms of
Yeah.
amortization?
So the biggest thing for the first-time home buyers is what's amortization? Because that's a word which if I go back,
Yeah.
right, I always thought my mortgage specialist is telling me 5 years, so I'm going to pay off the mortgage in 5 years. So for the audience, amortization is the life of the mortgage, the total amount you'll be paying. That's called amortization. It generally goes about 25 years or 30 years, which means if you're taking a $500,000 loan, that loan should be paid off in 25, 30 years based on the amortization. So that's called amortization, right? The term. And now there's a thing called term, which is you'll hear 2.09 interest or 5 point or whatever the interest. So term is the amount of interest you lock. So let's take an example. If I take a $500,000 mortgage, my amortization can be 25 or 30 years. So what that means is I have to pay down $500,000 mortgage in 25, 30 years. That's what technically means. But what I'm locking myself into an interest term, that's 5 year term, 4 year term, 3 year term, 1 year term, and 2 year term. And those are fixed or variable rates. So when I'm getting, let's say, 2.3% fixed, that means for that 5 year term, my interest rate will be calculated on 2.3%, right? So based on $500,000 mortgage, in those 5 years, that's what I'm only paying. That's called term. I'm locking myself into a 5 year term with a particular bank, right? Amortization is which I'll be paying. So what happens at the end of those 5 years, or 3 years, or 2 years, you can renew your contract. You can renegotiate the rate. But let's say if you've locked yourself for 5 years, your rate is set. If assuming you've gone fixed, your rate is gone set for 5 years. If the market goes up and down, your rate would not change. That's the term of a mortgage. When I go back, Yasin, many years ago, I didn't know the difference between a term and amortization. So I think it's a key point for individuals to know that a 5 year or the 2 year, 3 year, these rates are available in the market and variable. And then at the end of 5 years, then you can always renegotiate your contract or renew your contract or move mortgage around. People come here based on the rate they find. So those are the I would say important for people to know, right?
Yeah. No,
Um,
thanks for clarifying this. And while you're explaining this, maybe you can also touch upon how easy it is to move from one lender to the another, because oftentimes people see, oh, this bank is offering me 5 basis points lower. Should I move to this bank, and is it worth moving to a different bank?
yeah. Good question. So I'm going to say this, that once you're buying the house, once you're taking the mortgage, it's the biggest purchase of your life, right?
Absolutely.
So it's a dream. It's American dream. It's, if you call, I'm going to call it a Canadian dream. Right? It's the biggest
financial transaction you can ever make in your life.
biggest financial transaction you can ever take. So go with the trusted source. Go with the trusted source. Now, I work for Royal Bank, which is the biggest lender in the country. So I always say go with Royal Bank, right? But I always say people go with the trusted source. Find out what the bank is offering. Bank has been in existence for 150 years, what the rate they're offering. Now, somebody across the street might give you 5 basis points cheaper, lower than the bank. Find out who they are, what's their credibility, how long they've been in the business. Now, I have about 40 mortgage specialists in my team, been around for years, right? If, always available for service. We have branch network available. We have call centers available. We have a network available. Our client who buy mortgage from us can walk into a branch in Nova Scotia, or they can walk into a branch in Vancouver, anywhere in the country. They will be an RBC clients, right?
Yeah.
Now, you will find a 5 basis point might be lower than our rates are extremely competitive, but let's say if you find 5 basis point lower in the market, who are they? Can you find them when you need them? Are they available for you? Are they giving you the full-on guidance available? Are they helping you get the right mortgage, which is right for you? These are the things really important. So I will never say individuals that now I totally understand as a first home buyer. I bought my first property and I said that finances matter. You always want to make sure you have a steady cash flow, right? You don't want to pay too much because you don't know what else is coming at you as a first-time home buyer.
Yeah.
So you want to make sure you keep your rate low. That's why banks rates are extremely competitive in the market. We have very low rates in the market, and we are openly conditions now. I would never say anything bad about any lender, but there are conditions involved in some cases, right? If you go online, you'll find a lower rate price, but that means you cannot. I mean, there are many lenders out there, and there are many different conditions. You cannot sell your property. You cannot refinance your property, right? There are many restrictions that come along with. So, I would tell individuals strongly look at the conditions, and then find the right individual who's giving you the right guidance. The key thing here is when you're buying the property, it's a long process, right? And you know, as a realtor, how many times you have to show the house, and there's so much that happens. The appraisals happen, and then the lawyers happen. There's a team happen.
Yeah.
You always want to make sure that you are working with the trusted individual, who can close the deal for you, and then help you giving the right advice. I mean, for
Absolutely.
the long term, right?
It's a 3 to 4 month cycle easily, you know.
Yeah, yeah,
Yeah. Um,
yeah,
Thanks for that. So you mentioned about the refinancing, and a lot of people they don't understand, especially the newcomers
yeah,
or the first
yeah,
time buyer. And
yeah.
oftentimes when they purchase the home, they say, "Oh, I don't have enough money to do some renovations. Like, I need to buy furniture, I need to fix my boiler, or put on, new painting." Um,
Yeah.
how does refinancing help in this case, and what's the process?
Yeah, so refinance is a very common practice, right? Which technically means you're taking the equity out of your home. So, what is equity? That's also an important question. Simply, I'll explain. If you bought a $500,000 property and you put 50,000 down payment, so your mortgage is 450. Now, in 3 years, your house value, which was 500,000, have gone to 750, and the mortgage you took 450 have dropped down to 400,000, right? Which means 750 is the market value, mortgage is 400,000. In the middle, 750 minus 400,000 is your equity, right? Which means you can use this equity to 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 cash it out, right? That's what the equity is called. Now, what clients do, they refinance, they remortgage the house. They want to increase the loans. They want to take $100,000 out. So what they do in this case is that they take 400,000, they go to the bank that, can I take $100,000 out, which means can I take my mortgage and increase it to 500,000? Now, there's a qualification criteria, of course, right? You have to be qualified based on the income and credit. And if you qualify, you get $100,000 out. Your mortgage still stay the same, but now your new mortgage becomes 500,000, which means the extra 100,000 comes into your bank account. You can renovate, you can leverage the business, you can basement, buy extra property, whatever people do with it. That's a common practice. But refinance means you're remortgaging the house for extra funds. Right?
Yeah. I think a lot of people do not understand that if they have sizable equity, they can definitely use that to buy another property. A lot of people they struggle to put together another 20% down for the investment
Yeah,
for
it's a very common practice, and especially coming back to your point when you asked me earlier question that how are people buying so many properties? How are people qualifying their own properties? The house prices have gone up significantly. So majority of our customers are taking the equity out, as I mentioned. And with that equity, they're putting 35-40% down payment into the new property, right?
That's like
And that's a extremely common practice, especially in this market. Yasin, just give me 1 second. I'm going to put my charger on, okay? Just 1 second.
sure.
Right here. Yes, sorry. Because initially I put you on my laptop, but My phone is a little bit light on the battery. So anyways, almost there. Yeah, so coming back to the point of the refinance, this is a common practice in the market where customers are actually refinance, taking the equity out, and once they have the equity, then they just want to buy the second property. Is my camera okay? Not really, right? Okay,
No,
let's just.
it's better now. Oh, the video is stuck.
Sorry, did I do anything wrong? Perfect. Are we good?
It's yeah, it's
Okay, are we good? Okay, perfect. Sorry. Yeah, we're just connected. All right. So yeah, refinance, coming back to the point, very, very, very especially common practice, especially in the pandemic period.
Yeah, okay. Um, the other question I had was um, the mortgage protection. A lot of people they get confused. Okay, what is mortgage protection? Why do I have to buy it from RBC? Can I buy it for somebody else? And how is it going to protect me?
Yeah. Yeah, great question. So mortgage protection is also called creditor protection, right? So I'll explain you for the buyers that what kind of insurance they need, right? Especially for the first-time home buyer. So now, if you're putting 5% down payment, the first insurance you're going to go through is default insurance, right? That is with CMHC, as we just talked about the whole scenario, less than 20% down payment. Another insurance you want to buy is which you have to buy home insurance, right? Which means it's also called fire insurance. If something happens to your house, then you will be the insurance company will pay the bank and so on. So that's called fire insurance. Now, what is mortgage insurance or creditor insurance? Now, if you took a loan of $500,000, let's say, it's a loan, which means you have to make the payments on to the bank, right? Now, if something happens to you, knock on wood, hopefully nothing happens, life insurance will be paying off the bank, right? Life insurance will be covering the loan. It also includes disability payments. Now, for any reason you don't want, let's say for any reason you cannot work, for example, right? And if you qualify for the disability payments, the insurance company will cover the disability payments for you and will pay off your mortgage. So what that will do is that will keep your mortgage loan in a good standing with the bank, right? Now, is it mandatory, the creditor protection? That's not a mandatory, but highly recommended, right? Highly recommended because um, where now, when I look at the housing prices, when I look at the mortgage sizes, they have gone up massively, right? Mortgage prices, mortgage average has gone up. And I see a lot of our first-time home buyers is when they buy their first property, all of their down payment goes into all of the savings go into the down payment, right? Which means they don't have a lot of funds left after that, right? So God forbid if something happens, who's going to make the disability? Who's going to make the payment? If you something happened to our customers, from a life standpoint, if you have family, who's going to take care of that? So that's why it's very strongly recommended to take that insurance if you don't have a backup plan. Now, first-time home buyers, as I said, very likely because once you put everything into the down payment, there's very little left. Because don't forget that, and you know more than I do, is first-time home buyers, they want to buy furniture, they want to buy, decorate the house, plus they want to pay 30,000 or whatever the number is down payment, plus there's closing costs, plus there's disbursement fees, right? But there's very little left after first-time home buyers. So always protect yourself and don't go to a point where you cannot make the mortgage payments, right? Because at the end of the day, it's a loan and the payments have to be made, right?
Yeah, yeah. And I think it's basically for their own protection, right? So if God forbid something happened, um, and for some reason they're not able to make their payments, then this insurance will of course cover, their loss of payments, and to some point they can also cover their injuries and stuff like this. So I know that the banks also offer that, and the third party companies also offer that.
Yeah.
Do you know any benefits if people should buy from banks versus the third party companies?
Absolutely. So what the bank is selling is a group insurance, right? And what a third party is selling, it's general life insurance. So the qualification process with group insurance is easy, very easy, because You are part of a group. There are very limited amount of questions we ask, and you get quick approvals. Now, when you go through a third party, as you mentioned outside, you have to get vital signs. You have to get extremely rigorous underwriting process. And throughout that, you might be able to qualify or disqualify, right? And then you might be able to save 10, 20, $30, but somebody will check the life insurance, somebody check your vital signs, which means your heart and all those things, right?
Yeah.
And then at the end, they'll let you know that if you're qualified or not, you're qualified.
Yeah.
Well, credit insurance is a group insurance. You quickly qualify. We ask you 3 questions,
Yeah.
and your mortgage gets, your insurance gets qualified on the spot, right? So if I would be, let's say it's a customer, I'd rather buy the bank one because it's easy and I can quickly buy it. Because otherwise, if I go outside, then there's a very rigorous underwriting process that goes on. Now, however, some people also buy that, right? That's the personal choice individuals make.
Yeah.
But many individuals also buy credit insurance.
I remember, I've gone through this process, and at some point, the nurse came to my house. They took the blood sample, and they run the whole blood work to find out, am I healthy enough to kind of insure my life insurance? So that's kind of a process you have to go through, like if you buy this from a third party company.
Yeah.
Okay.
Yeah. So I mean, I would say it's very easy once you work with a mortgage specialist. There are 3 questions they'll ask you, and they'll be able to tell you approval right at the spot, right?
Yeah.
And the second thing, which is also very, very important, is insurance is when do you need insurance? When there are tough times, right? When there are tough times. So that's where RBC is extremely good. We pay our claims very, very fast, right? That's the key part, because you might find, as I said, somebody on a lower scale of the premium, but then would you be able to get the claim process in a speedy manner? Our underwriting, our speedy is extremely good, and we take care of our clients in terms of when we have to pay the claim. That's also a very key point. So always look for that particular point, that how are the claims being managed by the organization.
Absolutely.
Yeah.
All right. I think I run out of all the questions. If you have something else to share, feel free to go ahead.
No, I mean, first-time home buyers is extremely good journey. Massive amount of questions will come to the clients. I would strongly recommend to work with you, whoever the clients are, and I would strongly recommend to work with the mortgage specialist at RBC, because we know the process inside out. We know what it takes. It's not easy. There's many questions. There's lawyers and appraisals and realtors, as you said. There's CMHC. There's many people. Once you get to the second and third and fourth property, I mean, people tend to do, I know a lot by then. But if you're a first-time home buyer, work with a trusted individual who knows the market. Don't just go for a quick solution. This is not a quick solution. It's your biggest purchase of your life. Go with a good realtor, as I mentioned. You, Yasin, in this case, go with the mortgage specialist. Go with somebody who is recognized and trusted. And there's many facilities available in the market for you. And do your research, and then before you buy the property.
Absolutely. And then always get your pre-approval done before you go out and look for the properties.
100%, yes.
All right, thank you very much, Nabeel. I really appreciate the time. I know that you're a busy guy and you're doing your master's as well, and after, yes. So I know this is like, I did my part-time studies, while working. It's not easy. I can really appreciate
it. It's hard, and I mean, no, this is good, because I could recognize you almost getting to an hour. I thought it'll be like 15-20 minutes, but this topic is very, very important. So once you post this, if anybody will have any questions, they can always reach out to you, reach out to me. I'll be more than happy to pass on to one of our mortgage specialists, and or anything I can do, more than happy. Good luck on the first-time home buying journey to all the listeners.
Yeah,
it's a very exciting journey, very exciting. And always remember, you're only first-time home buyer for one time, because second time you would not be the first-time home buyer.
Exactly.
So enjoy this.
So I will post this onto other social media platforms. So do you mind if I share your contact details for people who?
Please go ahead. Go ahead. I'm okay with that. Yeah, go ahead.
Okay, yeah. Perfect. All right. Thanks.
Okay, sir. Nice talking to you. My pleasure. Thanks. Good luck. Bye.